welcome to our webinar today on how to invest in real estate with a subject to loan with guest speaker, Lindsey Jensen. We will invite Lindsey to start her presentation in just a minute, but I also wanted to get started with a small introduction to myself and Advanta IRA. We're hosting the webinar, and we help people with self-directed IRAs. My name is Larissa Greene, and I am Director of Education and a part of the business development team with Advanta, and I've been here since 2011. I'm going to give you a little bit of information about Advanta as well as self-directed IRAs, so you kind of know what we do, who we are, where we're at, and then I will turn it over to Lindsey. Here's my contact information on the screen for you in case you have any questions for me on self-directing your retirement account. Advanta IRA is retirement accounts that hold private investments, and there's a few other types of accounts that we can include in there as well, and I'll talk about that in just a minute. But we've been doing this for almost 20 years. In February, it'll be our 20-year anniversary. I'm really excited about that. But we can help anyone, anywhere that wants to self-direct their retirement account. So if you have a retirement account and it's with a brokerage firm and you want to hold something that's considered a private investment like real estate, private loans, cryptocurrencies, gold and silver bars and coins, you can do that. You just need a self-directed IRA administrator to assist you. And so that's what we do. We hold the account. You find the investment, we help you get it done in the name of the retirement account. Having an administrator allows your account to remain tax deferred or tax free, so it is a required part of setting up a retirement account that holds private investments. It's an IRS requirement that you have a third party administrator that retains the account and does the record keeping. We have almost 10,000 clients nationwide, and actually this slide says 1.3 billion in assets under management, but it's over 2 billion in assets under management. And we can help anyone with a U.S. account. So you could live anywhere in the world, and as long as you have a U.S.-based retirement account, we can help you with that account. And we hope that every single one of our clients feels like they're near our local office, because what we do is assign everyone an account manager, and that person is with you for the life of the account to help you make investments, take your annual contributions, pay expenses on behalf of an asset in a retirement account. And we have just found that that has really lifted the self-directed IRA experience to where people have confidence in the person they're working with and they know exactly who to reach out to. We talk a lot on our webinars about the different rules for self-direction. We talk about the structures of investments that we've seen. We invite guests on to talk about investing and the way that they handle different situations. But something that Advanta does not do is provide any investment, legal, or tax advice. So just keep that in mind. If you do have a question, we're certainly happy to hear it. If it's something that we can't answer, we'll let you know and maybe refer you over to an advisor or a CPA or attorney that can assist you with that. And on that same note, we do accept questions during the webinar. I am going to keep everybody muted just for having a clean recording. But if you do have questions, there is a question box. Just go ahead and type them into the question box, and I'll take questions throughout the webinar. I'll let Lindsey know if there's any questions that pertain to what she's covering, and we'll try to get questions answered. We are going to be on a time crunch, so we're going to do our best. And if you have any additional questions that don't get answered, you're always free to reach out afterwards. So what is a self-directed IRA? Well, for those of you that are joining and are brand new to Advanta, self-directed IRA is just as I said, it's an IRA account or retirement account that holds a private investment. A lot of brokerage firms will talk about having self-directed options on their retirement accounts, but what they're doing is offering you the opportunity to choose investments from a list of investments that they sell. And so we do something very unique. We don't sell anything at all. We simply hold the account, you find the investment, and that can be anything within IRS rules. And we do the opposite of brokerage firms where we actually don't hold anything publicly traded at all. So I've given you a short list here, but I would encourage you, if you're unfamiliar with self-directed IRAs, to join us for another webinar where we talk more specifically about the investments allowed, things you can and can't do in the retirement account, because there are some rules and it's important to understand them. So again, a self-directed IRA is a retirement account that you move over to Advanta, and I think that's an important step. People say, well, how do I do that? Do I open a bank account and then just move my money into there? And remember, the IRS requires you to have a third-party administrator that can hold the assets, and so that's who we are. You simply move your account over to Advanta. It is not an all or nothing strategy. You can move over just the amount you want to self-direct, and then we help you make the investment that you would like to make. So whether that's buying real estate, lending money, buying gold and silver bars and coins, investing in limited partnerships. We're going to assist you to make sure that the paperwork shows the IRA is making the investment. So this is not you borrowing money, but instead the IRA holding that investment as an asset. And you would see that on your statement, just like you would see, stocks, bonds, and mutual funds in your brokerage account. The different self-directed types of plans are listed here, and I always like to include this slide because a lot of times people say to me, well, I don't have a Roth IRA, so I can't invest in real estate. And I'm not really sure where that comes from. It's actually anything that ends in IRA that can be self-directed. And we also included here employer-based plans like SEPs and Simples, and solo 401ks can also be self-directed. We can assist you with that. I have on this list former employer plans, and there's emphasis there on former because typically if you're still participating in a plan, if you're a W-2 employee and you're employed and you're participating in that plan, they're not typically going to allow you to move a portion or all of that account. They're typically going to want to keep that 401k, 403b, whatever it is, with the administrator to help you to continue to make contributions and oversee that account. I am seeing more and more that when people are currently employed, they're being allowed to move a portion of that. And so you can always check, but definitely once you've severed ties with that employer, you're able to move that plan to a self-directed account. I also have up here health savings accounts and education savings accounts, and the rules for self-directing those are exactly the same as an IRA, and so therefore we can administer those accounts for you as well. We're getting up to that time of year where we're at open enrollment for healthcare, and so if you're shopping for a high deductible healthcare plan, if you're looking at what contributions you want to make to the various plans before the end of the year or into the start of the next year, this is kind of the busy time for us, and so we're definitely answering questions about that. We have a lot of great webinars that we've just done or coming up on end of the year tax planning. So I would encourage you to check out our website, visit us on our YouTube channel, and find out more about that as well. Real estate options for investments, really the sky is the limit, and the IRS only says that you can't invest in life insurance and collectibles. And so when you're looking at a different investment option for your retirement account, as long as it's what the IRS would consider an arm's length transaction, and again, I won't talk too much about that here, but we definitely have webinars on that information, then it's probably something you can do in an IRA. And I do a lot of networking for Advanta. I go to a lot of classes. And when I hear about different investment structures or ideas, I'm always kind of thinking, well, that's something you can do in an IRA. And typically when you're making an investment for investment purposes, the IRA could make that investment instead. And you can have that investment or structure grow tax-free or tax-deferred depending on the type of account. So you can invest in joint ventures, you can buy real estate, so you can hold a deed in your retirement account for short-term and long-term rentals. You can invest in syndications and real estate options. We have people invest in tax deeds and tax liens, lending, and that could be first, second, third mortgages. It's completely up to you as the IRA holder. And so the list really truly does go on, and you'll see a lot of different structures if you join more of our webinars and we talk about those different structures as well. And something that we talk about a lot as well is buying mobile homes, whether you're buying an individual mobile home or a mobile home park, for example, or investing into a syndication for a mobile home park. So you'll see a lot of that as well. And so that really is it for my portion of this presentation. Again, if you have questions on self-directed retirement accounts, you can certainly reach out to me, check out our YouTube channel, or visit our website. We have webinars all the time, and so we have a lot of great ones coming up. And with that, I'm going to turn everything over to Lindsey. How are you doing today, Lindsey?
I'm great. Thanks for having me, Larissa.
Thank you so much for joining us. So again, Lindsey is going to take some questions during the webinar. Again, time depending, but I would encourage you to type your questions into the chat box. I will be monitoring that for you. And with that, go ahead, Lindsey, take it away.
Okay, well, thanks everyone for coming today. I'm going to talk to you a little bit about how I built my portfolio using someone with an IRA and subject to investing. So this is near and dear to my heart. It's one of my favorite strategies to use with investing. And there are so many ways to partner with people with IRAs in order to do this. Slide. So again, my name is Lindsey Jensen. I have been doing this full time for about 6 years. I am a landlord, a wife, a mom, marketer, a little bit of a flipper, problem solver, creative deal structure, and student. And then Clever Kitty Investing is my company that also teaches how to do what I do. So one of the things that I want to get you guys to think about is I want you to think about where you want to be in 5 years. There are so many times that we listen to speakers who say, you know, they're doing 5 to 10 properties or more per month, or you know, they own 100 rentals or something like that, and it seems so overwhelming. I want you guys to know that I started 6 years ago, and I never did mass quantities of flipping or acquisitions in any one month. I don't think I've ever done more than 10 in a year. So this is something where you do not have to be overwhelmed by the number of properties that you are getting in order to build a large portfolio. In that 6 years, I've been able to build a $10 million portfolio, and I'm going to share with you one of the biggest strategies I used in order to get there. So buying a property subject to means that the buyer, you as the investor, you're going to be taking over the seller's remaining mortgage payments. Buyers do not formally assume the loan. You are not assuming the loan. It is not going to be in your name. It is going to stay in the seller's name. But the title, the deed, will transfer from the seller to you as the buyer. So you are going to be the actual owner. You're the one that's going to get the tax benefits, okay? You're going to be the one on title. So one of the common misconceptions about subject to is that it's illegal, or you're going to go to jail, or I hear this all the time. And really the only thing that is going to cause you to do that is if you promise someone you're going to pay their mortgage and then you don't. Okay, this is a HUD-1 settlement statement. You should see this at every single closing. And I just want you to see on there that there is a spot for existing loans taken subject to. It is 100% legal. Okay. So this is something that we do all the time. Title companies do close on this, and there is no consequence for doing these types of deals unless you do them wrong. Slide. So why would anybody want to sell their house subject to? Well, let me tell you, there's quite a few differences in why. First of all, they owe too much money. Most of my portfolio was taking over loans that owed too much in order to be sold on the market with a real estate agent. And I'll give you some examples of that in just a little bit. Maybe they need to sell quickly. Maybe they need to be out of their house in less than 30 days. Believe me, there's plenty of those people out there. Maybe they have a mortgage paid on, you know, one of the reasons that they'll say yes to this is if you pay their mortgage on time, it will increase their credit, okay? They can pocket more money than was selling with an agent. So I've had some people who would have had to bring money to the closing in order to sell their house with an agent, where I could actually pay them some of their equity out because they're allowing me to take over their loan, and it makes it affordable for a renter. Also, you know, the terms that they make with a buyer may be more attractive than they could get if they sold it on the market. And there's numerous ways that can happen, and I will show you some of those as we go. So the advantages for you buying subject to is that there's a lower barrier to entry. You're not going to have to come up with 20% down on everything. And to be honest with you guys, when I started this, I did not have a lot of extra money. I did have some money to get started, but I did not have a ton of extra. I partnered with somebody who actually taught me to do this. My mentor taught me to do this. He had an IRA, and he gave me the cash I needed in order to do these subject to loans. So not only is it a lower barrier to entry, but you really could create deals where you're not putting any of your own money in these deals. You can start investing no matter what your credit is, okay? Subject to does not matter because you're not qualifying for a bank loan. You don't have to wait to get a bank loan. You can close these in such a short period of time. You can close these within a week. You can pay more for a property. So there's very little competition when you're doing these kinds of deals, okay? You're gonna get better interest rates because let's say you're taking over a loan that's a VA loan. There's a lot that I have that are 2 and 3% loans. And I'm not gonna be able to get those as a non-owner occupied buyer, okay? Getting a loan several years into payments. So there's less interest and more principal being paid down. So if you take over a loan that's maybe 5 to 10 years into the pay down, you're going to be paying a mortgage that has a lot more going towards principal than interest. There's also cash flow and equity. This gives buyers a chance to cash flow on properties that would not cash flow if they put a new loan on that same house, same deal, same purchase price. You know, and the buyer, you as the investor, is the one that gets to write off the depreciation on their taxes. And this can help with the amount of taxes you have to pay on your earnings. So if you are a flipper, or if you do have to pay a lot in taxes, or even if your husband or wife has a W-2 job that makes a lot of money, this can help offset that income. I know for us, it was between $3,000 and $5,000 per house that we took on. It saved us between $2,000 and $3,000 per year on taxes for each house. And it's a great way to get more than 10 conventional loans. Now, there are some risks to buying subject to. There is a due on sale clause. Now, again, as long as you're paying the loan, a lot of times these are not going to get called due. You do have to warn the seller that this is a possibility, but as long as you have a backup plan for if that happens, it shouldn't really bother you, and most people have never had this happen to them ever. Again, the due on sale clause is something that they can do. It doesn't mean that they will do it. One more time, go back. I apologize. Okay, so
Okay. That's good.
again, thank you, Larissa. Again, you better be able to pay that mortgage. You can hurt the seller's credit. So this can cause you to have legal troubles. This is where some people get into trouble. If you know what you're doing, you know how to rent a property out, this is such a great way to build an entire portfolio. And remember, this sale is final. This is what you want, but make sure you're willing to wait. You're willing to wait this out if the market is to go down. You know, a lot of times I plan on these deals being a good 10-year deal. So ways to structure a subject to. You can structure it as is. So that just means that you're going to close on the property and start making mortgage payments, and no money is due at closing. So if they're just ready to get out and they want to go, you just say, okay, great, there's no equity in your property. I will take this over and you guys can go. And a lot of people are very happy with that. I am going to say, if you're going to partner with somebody that has, or maybe you're the IRA holder and you find the deal, maybe what happens is there's a little bit of rehab that needs to be done on the property. Maybe there's $4,000 or $5,000 in painting that has to be done. You as the IRA holder can loan that money to somebody else and they could have the subject to deal and you get 50% of that deal. Or you as the investor, you find someone who has an IRA and you say, hey, you know, this needs $4,000 or $5,000 worth of repairs. If you'll give me that $4,000 or $5,000 for the repairs, we can share this deal. There's also cash. So that just means you pay the seller the difference between what they owe on the mortgage and the agreed upon sales price at the closing table. And again, that's where the IRA holder can come in and be a part of the deal. There's a seller carryback. So let's say that the seller owes $100,000 and the sales price is $150,000. So the seller would get a note and a deed of trust or a mortgage, depending on what kind of estate you live in. And it says that they're owed $50,000 at some point in the future. And you guys could make that 10 years in the future. You could make it whenever, it could be upon resale or refinance. It depends on what you want, but there's a lot of ways to do that. There's also a combination of cash and seller carryback. So maybe the seller gets $25,000 at closing, and then they get $25,000 in the future in the form of a note, deed of trust, or mortgage. And there's also the possibility that the seller gets monthly payments of $200 a month or $100 a month that goes towards the full $50,000 or the $25,000 that's left. There's endless ways to structure these deals. Every single one of them is different. You just have to listen to the seller and see what they need and make that deal.
And Lindsey, we had a question pop up. How do you handle homeowners insurance? And the person asks, do you leave the policy in place or do you get your own?
No, because you are now the owner, so you're going to have to get your own policy. So I always instruct my seller to go ahead and cancel it on the day of closing, and then you get your new insurance policy, okay? And I purchase these in the name of a trust. So my insurance is going to be in the name of the trust. And I am going to tell you that insurance always likes to see the seller's name as an additional insured on there because their name is the one on the loan. So you're always going to want to put, like maybe I would put either my company as an additional insured or Lindsey Jensen as an additional insured, and then also the sellers as additional insureds.
Okay, that's a good point. And also, are you seeing, there's another question here, are you seeing or hearing from other investors that there's people experiencing crackdowns from banks because of the change in the interest rate on subject to loans?
No, not at all. There has been a change in how banks do all that. And so for the most part, as long as those loans are being paid, they don't much care. Okay, so like I said, build a portfolio with sub-twos and an IRA. I'm sitting in this picture next to Michael Jake, and he is my mentor. He is the one that taught me how to do all this. I owe all of this to him. He knew how to do the IRAs, the subject twos, before I knew what the heck I was doing. So he came, I was able to find the deals, and he taught me how to close them, how to handle them. He taught me everything about them. And we shared in these deals 50-50. And I'm going to show you how we did that. But the neat thing is if you're the IRA holder and you learn how to do this, not only can you mentor someone who's brand new in the industry and really hungry, you don't have to go find all these deals. You can mentor someone and say, here's what's possible, go find these deals. And then you give them the money and teach them this stuff, and you're getting half of these deals. So partner with someone who's new and hungry. That's what I did. And then the other nice thing is if you're the investor that doesn't have any money, learn how to do this and then go find an IRA holder. Maybe you split it 50-50 still, but maybe if you know what you're doing the whole way through, maybe you can say, hey, you get 25% or work something else with that IRA holder. It doesn't matter. It's whatever you guys decide on, but there's a lot of opportunity here for both you and an IRA holder.
Lindsey, another question popped up. Do you feel like you're always getting a better interest rate? And what do you do if a seller has like an ARM?
I would think twice about doing it with a seller with an ARM. Like look at the loan paperwork and make that decision. I can't say for sure yes or no because I'd have to see the paperwork, right? And how much can it adjust on a yearly basis? Is there a max amount that can adjust and when? So it still may be feasible to do with an ARM. It just depends, okay? But you're gonna have to take a closer look at that and make sure you, if you haven't done a lot of these, make sure you ask someone who really knows what they're doing to give you some advice on that. I have never, they don't do a ton of those anymore, so I haven't even run across that. But always double check and make sure when you're doing a deal with someone that you see their actual loan closing documents and double check what those, what they closed on and what their loan is. So you know if it's fixed, if it's going to adjust, or you just know the full amount of what you're getting into.
Great, thank you.
You bet. So I'm going to talk a little bit about why this structure is good for the IRA, okay? First of all, the IRA is going to be a lender in the circumstance I'm going to be teaching you today. So there's no UBIT. So there's still a loan on the property, but because whoever the investor is that's holding the property, the IRA is actually going to be giving them almost like a second loan. Okay, so there is no UBIT, but you still get a property that has a loan on it, which is pretty cool. So as you can see in this picture, the self-directed IRA, it buys the property, it receives rent, it has to have a non-recourse loan with a mortgage company or lender, okay? This doesn't matter in this instance with the subject to. So the IRA holder is not managing the property at all. The main investor is doing that. So in this case, I'm just going to use Michael, Jake, and I as an example so that we don't get confused. So Michael, Jake, and his IRA were not managing the property. I was doing that. He gave me the money I needed to close on the deal. No payments are made on or for the property ever come from the IRA holder. I handled all the payments, all the rehab. Now the IRA holder, Michael, Jake, and his IRA got equity and cash flow. He got half of any equity when we sell or refinance, and he gets half of the cash flow if there is any, okay? The IRA holder may be an active investor that wants to take a more passive approach. So this is great for the IRA holder who's like, hey, I just want to give out money and get some more equity and some more cash flow. And again, it was great for me because I was fine being active and in the trenches and doing all the active work, but he was giving me money that I didn't have. So I was getting half of all of these houses that I could not have otherwise taken down. Now, the investment income exempt from UBIT includes the following. So I just want you to see why this is exempt from UBIT. It's because interest income. So when we write these deals, it's anything I'm paying him for cash flow or equity is written in as interest, which I'll go over with you in a little bit. And that is exempt from UBIT, okay?
And also, I just want to mention really quickly, if you're unfamiliar with UBIT, there's only 2 instances in an IRA where it would be exposed to a tax called unrelated business income tax. And we actually do have a webinar on our website and on our YouTube channel about unrelated business income tax. But those 2 instances would be 1, business income returned to an IRA based on an investment, and then 2, an IRA buying real estate or basically financing to purchase an asset in the retirement account. So those are 2 instances where an IRA would be exposed to unrelated business income tax. And so if you were going to buy a property and finance it in order to purchase, or for whatever reason, then you would be exposing the IRA to unrelated business income tax, and also is sometimes considered unrelated debt financed income tax. And so you could definitely jump on our YouTube channel and check out a webinar on that if you're unfamiliar with it.
Thank you, Larissa. That's awesome. And obviously, Larissa understands all that stuff much better than I do. But what I know is that if Michael Jake had purchased, if he had purchased those sub 2 houses just by himself, that would be subject to UBIT. And correct me if I'm wrong, Larissa, because it has a loan on it. But by loaning me the money and having me handle everything and me take title, there was no UBIT for him. So he still got to be able to do that.
Right. So him as the lender is exactly as you said on the last slide, because he's receiving interest income, he would not be subject to the UBIT tax. And the thing about it is really that the IRS basically says, well, you can get a loan, you can finance a property in an IRA, we're going to let you do that, but it has to be 1, non-recourse, and 2, it does expose the IRA to a tax, because now you have income related to monies that are not IRA monies, so meaning the debt. And so that's really sort of where that idea comes from. And so, you do just have to be aware of when an IRA will trigger UBIT. And I think that's always sort of the big question out there. But when it comes to debt financing and real estate assets in an IRA, that is definitely going to trigger UBIT. The other circumstance, there's a lot of sort of nuances with it. But in this circumstance, yes, if he's lending money, he is not going to be subject to it. If he's buying a property with a loan or using a loan, then he's going to be subject to UBIT.
Awesome. Thank you for helping me explain that. That was awesome. Yep. And that's why this structure is so great for both the IRA and the investor. Okay. So why is this great for the investor? So for me, these are the reasons I felt this was great for me. So you want to get started, but you need the money. I did not have all the money that was needed to purchase all these houses that we purchased together. I also needed a mentor. I had not done any of these things before, and I was able to learn while in the trenches doing deals, deal by deal, and having someone look over my shoulder. So he wasn't going to do something that was going to put his IRA at stake or me. And so with every deal, not only did I learn, but I knew it was a good deal because Mike had looked at it and he was doing it with me. So it made me feel very comfortable moving forward very quickly. Again, I got half of a house that I wouldn't be able to get otherwise. I've had people say, yeah, but you gave up half a house. No, we shared in half a house that I wouldn't have been able to get, okay? The investor gets to own the house, meaning I own the house. So I can refinance at any point that I want to pay off the IRA holder. And I get the tax benefits. So it's a wonderful situation. And then again, I still get half the cash flow. But again, you guys think about this. If you're the one learning the sub-2 side of things and you're the investor, I didn't know how to do this. So not only was I being taught, but I was also getting money, right? And I still got half of everything, which is a pretty darn good deal. If you're the investor, so like now maybe I could pull off a better deal with the IRA lender, right? If I only need $5,000 or $10,000, I'll say, hey, I'll give you 25% instead of 50 because I know what I'm doing. All you need to do, all your involvement is just giving me IRA money. And again, this is dependent on the IRA holder, depends on what you figure out with them, but just understand that there's other possibilities. I'm going to give you guys a couple examples of how some of my deals went and the returns that we got on these. Now, we found this deal door knocking. Some of you might know who Bill Cook is, and you will see him in this picture right here. This was my first time ever door knocking with him, and there was an owner that had a property on the market in this house that we knocked on, and they were told by the agent that they weren't going to be able to sell it while they had renters in it. And Bill turned around kind of laughing, going, well, we have a whole yard full of investors that don't mind buying properties with renters in them. So I ended up talking to this seller, and she really needed to leave. Like first of all, she had already bought a property in another state. Her daughter had died and she needed to go take care of her family. So she had already moved. She needed money for her new house, and they could not afford a vacancy in this house. The ARV at the time was $275,000, and the seller needed $15,000 in repairs on their new home. If she had sold it with an agent at $275,000, which again, it had been listed for quite a while and was not selling, you multiply that by 0.92. What that's going to do is pay for the agent's costs and the closing costs. This is just an average. That means at the end of the day, she would have net $253,000. Okay, and to do this, she would have had to make the repairs and get the tenants out and paid holding costs while those tenants were in there, and she did not have that money, and it would not have netted her $15,000 after she paid off her loan. Oh, go back one, I'm sorry. So we said, okay, here's the deal. We're going to give you $15,000 at closing if we can take your loan subject to. So the final sales price was $251,000, and the loan balance was $236,000, and the cash to the seller at the closing table was $15,000. There were repairs for about $5,000. Again, that's where it just needed some paint. And then the closing costs were about $2,000. So all in cost was $258,000. The monthly payment on this was about $1,300, and the rent at the time was $1,600. So it cash flowed really nicely, and we were going to be able to split that. The financial partner gave me $18,000 in exchange for 50% of the property. So again, I'm the owner of the house. I did not have to bring any cash to this deal because I'm the one that found it. And he taught me how to do, this was one of my first subject twos. So he taught me how to do all the paperwork, how to do the closing and all of that, along with giving me the cash to make the deal happen. The current equity is $240,000, and this is only 6 years later. 6 years later, we have an equity position of $240,000. Okay.
Are you there?
So, go ahead. Okay. So
I think I lost you on the audio. I don't know if everybody else could hear you, if it was just me, but go ahead.
okay, where did you lose me?
You were at the current equity.
Okay, so the equity is 240,000, and that's what we have in it now, and we split that. So what happens is my financial friend gets his $18,000 back first, and then we split $222,000. So in 6 years, that's $111,000 to each of us. The IRA gets that plus all of the cash flow during that 6 years. So remember, you can see that the home value then was $275,000, and now it's $465,000. So that's a sweet deal. And remember, if you're doing 10 of these a year in 10 years, you're going to have an average of $1 million per year.
So and you did have some and you did have some questions pop up.
Okay.
And also somebody did say that your audio was fine, so it must have been me. So thank you for posting that, guys. So we did have a question on, do you set up a new trust for each subject to deal when you're setting up the deals?
Yes, every single one goes in a trust, a land trust, and I just name it the name of the house. Like this one was 6195 Emma Lane.
Okay, got it. And then do you also notify the lender that someone else will be making the payment?
No, I don't actually. There's nothing wrong with that. I know some people who do notify the lender. I just take over the loan and we put it in. I also have a management company, so we just make the management company make the payment. I've never had any questions about it, never had any trouble.
Okay, great. Okay.
All right, so this is the second example. The seller filled out an online form on the website. They had gotten into trouble on a flip and needed to sell their primary quickly so they could move into the flip and finish it. And they were literally one payment away from defaulting on their loan. They owed $282,000. The ARV was $320,000. There was not a lot of room for them to actually sell the property and make money. And they really needed $10,000. They also had $20,000 in repair on this house. If you can see that upper deck, that upper deck needed to be replaced, and that was a $15,000 repair. And then it needed painting inside. So it needed, I mean, they would have had to spend they wanted $30,000 technically out of this on top of that, and that there's no way those numbers would have worked. We were able to pay this because it was a great, beautiful, amazing house. The payment wasn't too bad, and eventually some of this, one of the things you'll want to look for is if there's MI on it, that's mortgage insurance that will eventually fall away and make you more money. This one actually does. So the total was $1,700 PITI, $385 for the HOA. So the total payment was $2,085, and it would rent for $2,100 to $2,200. So the purchase price was $292,000. So it was the loan balance plus the $10,000. My financial partner gave me $25,000. Obviously, they give that, the IRA gives that money to the title company at closing. So that was for the $10,000 that the sellers got plus the money for repairs. And the financial partner gets a deed of trust and a note signed by me for the $25,000, and interest to be paid as 50% of any yearly cash flow and 50% net profit when house is sold. And again, this was taken subject to the loan balance, so I paid their mortgage. And again, this house rented out long-term at $20.50. Obviously, that's higher now, but we still have the same renters in there. The current equity in this, and we've only owned it a couple of years, is $90,000.
A question popped up. How do you get the loan information to make the payment? Do you ask the owner to turn over the mortgage info, login information, and all of that?
Exactly. They have to turn over everything to you. It's for their own interests, obviously, because they want that mortgage paid and they need that good. That will keep their credit good. So you You have them give you all their loan information, all the login information, everything they need, a limited power of attorney so that you have the ability to get information from the loan company if that's what you need. So yeah, there's a whole list of documents you need for the closing.
Okay. And who do you typically use as a trustee? Do you hire a professional trustee or are you working within your inner circle?
I use myself as the trustee.
Okay.
But you don't have to. You can definitely get a trustee and find someone in your inner circle to do that. It just depends on how you wanna work it.
Great, thank you.
You bet. Okay, so I'm gonna start going a little faster here just so we can get through all this. But the seller called from a direct mail postcard on this house here. They had just refinanced their house and taken cash out to pay off debt, and they now owe 100% loan to value. They had wanted to move down to Texas, but jobs were not lining up, and suddenly they got transferred and had to be down there in 30 days. These people would have had to bring $30,000 to closing in order to sell their house. They couldn't do it. Plus, their house needed $10,000 in repairs. So that's a delta of $40,000 for them to get rid of their house. It was a beautiful house. They owed $276,000. The ARV was $285,000. And they needed to leave as quickly as possible and pay as little as possible. The house needed $10,000 in repairs. The payment was $1,850 PITI plus $45 HOA per quarter. The rent was $1,800 max. They would need to come up with at least $30,000. I already said that, sell in the market. So the buyer pays the closing costs and will make repairs, take over current loan sub 2. That's how we structured this. So what I did was, because I couldn't rent it for as much as their payment was, what I did was I said, hey, look, I can do this. You're not gonna have to pay $30,000 in closing, but I would like you to repay the $10,000 in repairs and the rent that we can't cover for 2 years. They said, that's great, we can do that. So they made a payment back to me for $344 per month for 24 months. The financial partner brought $12,000 to closing to cover repairs and closing costs. And again, that was for 50% in net profits. So the documents that we did were the sellers had to sign a note showing that they owed $8,260 at closing, along with an ACH form allowing me to use my software to pull it directly from their account every month. The long-term plan was to keep and rent it. The current equity is over $165,000. So again, my IRA partner is going to get the first $12,000 of that, and then we split $153,000. And that's if we were to sell it now, but we plan on keeping these for about 10 years.
A question popped up. Do you ever sell your homes on a lease option?
No, again, it's something you could do, but it's not something I prefer to do. I want to keep these long-term and possibly pay them off and keep them as retirement. So again, there's a lot of different ways you can structure these.
Great, thank you.
Yep. Last deal. This was again a website lead. The sellers were 2 sons that were selling their late father's house, and they had tried to rent it for about a year, and they didn't like doing it from another state. Okay, so the renters had really ruined the inside of the house. I sent them pictures as how bad it was. I mean, you could literally see the dirt on the walls in the pictures. It was bad. So it needed new paint and carpet, but it was a beautiful house in a beautiful neighborhood. They wanted to sell it as is with the renters and wanted $38,000 cash. So they owed $240,000 on the mortgage, and the ARV was $310,000. I believe this is like a 3% interest rate, and the payment on it was $1,436, and the rent on it is $1,800 minimum, which is much more now. So this thing cash flows like crazy. So we went ahead and gave them $38,000 is a little higher than we normally liked to go, but for this house it was okay and it warranted it. The other nice thing was, because the loan is in someone who had passed away, unfortunately they had passed away, but we don't ever have to be pressured to pay off that loan. Nobody cares that it's just sitting there. So the offer was that I would purchase the house subject to the loan. We will take it with the renters and do all the repairs. We'll pay the $38,000 cash at closing plus all closing costs. We get to keep this house loan, again, we get to keep this loan forever. Renters moved out right after we purchased it. We got new carpet and paint in there. The repair costs were about $6,000 and closing costs were about $1,500. We did get it rented immediately for $1,825 and it's not been vacant for even one day. That's the power of having it in a good neighborhood. My financial friend gave me $35,000 for 50% net return on the house. And because I put a little bit of money into this deal, because it was a little more than he typically wanted to put in, but I didn't mind putting some money in at this point. But I was able to pay myself back anything I had put in first before he cashed out, or before he gets any 50% of any cash flow. So again, these are the terms that you can work with people. I said, hey, if I put this money in, can I pay myself back first? And he said yes. And the current equity in this house is $210,000. So again, the way we have it worked is that he gets his $38,000 or $35,000 cash out first, and then we split the remainder of the equity. So I'm going to talk a little bit about the note and then the deed of trust or mortgage, depending on which one you need in your state. So the language on the note that we use is, in return for a loan that I have received, I promise to pay $35,000 plus 50% of the net profit from the resale and half net monthly cash flow as interest in order of the lender. The lender is IBAT, FBO, John Jones, Roth IRA, or whatever that is for that IRA. I just put that in there as an example. I will pay principal and interest by making a monthly cash flow payment if applicable, and a single balloon payment of principal and interest due on resale projected to be, and then we put 10 years out, that can be anything, or sooner unless note holder agrees to extend. And again, my partner is fine extending if that's what we decide to do. So, I mean, just remember, you can talk with your note holder, see what they want to do and what they're willing to do. I'm going to give you an example of what we do in our, oh, sorry, Larissa, can you go back one?
Yeah.
I apologize, you guys, there's a delay, so sometimes I think it's not working. Deed of trust and mortgage. So I use deed of trust in my state. Remember, the deed of trust and the mortgage is what glues the note's promise to the house. So the note is not recorded. That is what the IRA holder keeps. The deed of trust or mortgage is what is recorded and says, hey, there's a note somewhere for this amount, and this is how you do that. So again, this deed of trust is dated, and you put the date in there, by in between, and then I put the name of the trust, Lindsey Jensen, trustee, the grantor herein, whose address is, and then I put my address, and then you put the IRA holder, whose address is, and then you say the grantor by an agreement dated even herewith is indebted to the beneficiary in the sum of $35,000 principal. And you can see I have a typo. I was trying to change these a little bit for you guys. But that was $35,000. Principal and interest are to be paid in such a manner in such a place designated by the lender. So, and then obviously this is like, this is the legal description of the house, sorry. So this is kind of, this is the language you're gonna use. And again, I don't make a monthly cash flow payment to my lender. That's a lot going on. I keep a running tally with my software all throughout the year. And at the end of the year, I give a report to my lender and I say, here's the cash flow on this house, and I make a half of a payment to him. The nice thing is, so I use Buildium, I'll just tell you, it is amazing. It keeps track of all that. And at the end of the year, because I put both of us as 50-50 partners, it straight up tells me what he is owed. And I just click a button and it pays him. So it is very easy to keep track of. Again, we've done tons and tons of deals together. So I don't leave that to my brain to calculate. I use software.
Okay, great. And we did have a couple questions pop up. One person wants to know if the seller's loan is subject to, how do they go about buying another home if that is where, where they're moving to, they're going to buy a house or something like that? And is there a way to work that out for the seller?
This is going to be dependent upon every single seller. I've never had a problem with a seller getting another loan. you do want to let them know it may impact them, because again, every seller's credit is different, every seller's debt to income is different. Like I just did one of these, and the seller, one had a VA loan, but they only had one of them on it. So their husband was able to use the other one to buy when they moved back to Kentucky. Okay. So a lot of them already have that figured out, or, you know, the debt to income just works well in their favor. Sometimes they don't even care. So you do want to ask those questions. I say, hey, are you looking to buy anytime soon? But you just have to ask those questions.
And another question that actually a few people asked, could you tell them what that software was again that you use?
Buildium, it's called Buildium. And that's what I use to keep track of my rentals.
Okay, great. And an attendee asks, how much money do you budget for repairs on a property going forward? So I know you mentioned each house might have, you know, a certain amount that you're expecting already as you go into it, but then what do you budget going forward?
So in the beginning, before we had a lot of cash flow, I built up a $5,000 reserve for each property just to use in case we needed it. And then once I had enough monthly cash flow where all these properties together gave me, you know, enough reserves on a monthly basis that I didn't need that anymore, I dispersed those funds.
Okay, got it.
So I'm going to talk to you about why you should learn this strategy, especially in this upcoming market. You guys, I'm already seeing it big time, big time. People bought houses for too much. They're not going to be able to sell them to people with 7% interest rates. They're not going to be able to sell them quickly. Houses are sitting longer now. Help them. I mean, my people cry when I help them with this stuff. I'm not joking. They cry when I am a solution, because there is no other solution. Again, as an IRA holder, you have something special to teach a new hungry investor. You can fund their deals. It's also something that you should learn as an IRA holder so that you know how to look at these deals and see if they're good for you. You can get half of a house for not as much money. Your IRA money is going to go farther. There's no UBIT and no tenants for you as a lender. As the investor like me, this skill set will set you apart, okay? There's not as much competition. You can offer amazing returns on smaller investments. So, you know, when you say, hey, you have an IRA, will you partner with me? They can give you a smaller investment amount and you can offer insane returns. I mean, do the math on some of the deals I just showed you for what my IRA lender gave me and what he's getting in return tax-free. And you can make deals work that others won't be able to. I already said that, but like there's almost zero competition if you can do these deals. And again, you can grow a $10 million portfolio in 6 years. And that's what I've done. And you guys, I am the main caretaker for my kids. This was not full time for me, even though I did dive in head first. I never did 5, 10 deals a month or anything like that. You do not have to stress yourself out like that in order to grow. Slide, oh, there we go. So how to sub 2. So I tried to pack this jam-packed full of information for you. If it wasn't enough and you want to learn more, I do have a course. Please feel free to reach out to me with questions too. But if you would like a structured way to learn this, I do have this, and this is what it includes. Why people say yes to sub 2 offers and how to find these people, risks and how to avoid them, how to use land trust with sub 2 deals, loans to avoid, different ways to structure sub 2 deals with examples, what to do with judgments and liens, how to handle a new lead and prep for the meeting. You get the seller questionnaire I use and how to do comps, organization for sub 2 deals, because there's a lot that goes into these, what to say to a seller during the meeting, how to handle questions and objections, how to handle the insurance, which we did have some questions about that. I go into more detail on that, how to write the contract, and you get my contracts and you get all of my paperwork. You get all the paperwork and documents you need to do these. And again, if you live in a separate state or a mortgage, it just needs to be tweaked. So just make sure that these work in your state. I would just have it looked over, but for the most part, they should work anywhere, and at least the idea of them. And then obviously how to write the deeds and notes for the IRA lender, okay? I do normally charge $14.99 for this and all these documents. For Advanta, I will give it to you guys for $7.99. When you go to my site, www.cleverkittyinvesting.com, use the code Advanta. Click on my sub-2 class, check out, use the code Advanta, and that will give you the price of $7.99. If you have any trouble, please feel free to reach out to me. And again, I will give you my 100% guarantee if you do not find value in this class, if you don't feel like you got my all, there's nothing else to take after this. Like, I didn't just give you a portion, I gave you everything you need to do these deals. I will give you your money back. It does not matter to me if you do not find value in this stuff. If you don't think that you got it, I will give you your money back. So I want you guys to be able to go out there and help people. I don't want you to hurt people. I don't want you to hurt yourself or these IRA lenders. So if you purchase this class and you have questions, you can call me and ask questions, okay? And then I'm just going to go to the next slide. And again, it's www.cleverkittyinvesting.com. And this is my contact information. And I want to thank all of you so much for joining me today. And I want to thank Larissa and Advanta for having me. I love Advanta. They are so knowledgeable and so easy to get a hold of. And I have an account with them too. So I just want to really push that they're amazing. So please reach out to Larissa and get an account set up.
Thank you so much, Lindsey. And thank you so much. I do see a couple other questions popped up. I just want to circle back on one because I had it pop up a couple times asking about the structure or agreement between you and the IRA lender. And I think there's a lot of emphasis on it depends on the deal and what works for that specific deal. And so Lindsey mentioned a lot of times that her and this particular lender work together a lot. And so they work well together, meaning that when the terms work for both of them, then that's agreeable. Lindsey, would you talk a little bit about what you're typically doing with your IRA lenders?
Again, my main one, it was my first mentor, and that's because we work really well together. We really like each other. A lot of times, like, and if I still needed money to work with him, I would go back to him 100%. We're looking to teach together and stuff like that now too. And I appreciate the fact that he taught me everything he did. So, do a deal or two with someone and see how you like working with them, but also lay out the expectations first. In this deal, he doesn't tell me how to run the houses. He does not interfere with that side of things, but he also trusts me to take care of them, okay? And because he saw how I took care of houses, like I would send him screenshots of what renters were doing in my properties without any of our money. He knew I was finding good renters. I would tell him what I was doing. There was a full open dialogue, and I did try to brag on myself, and I don't mean really brag on myself, but I would try to show him how well things were going. That gave him trust in me. And therefore he didn't feel like he needed to interfere. So I just tried to make it so easy for him to invest with me and know that he didn't have to do anything, that it worked really well and we became really good friends. And so, I just say it doesn't always work. You don't always get along with the person that you're working with. So have those conversations up front. And if it works, then do more.
And thank you for that, Lindsey. And I think that's so important because especially as a self-directed IRA administrator, a lot of times people will say to me, well, how should this deal be structured? And we can't answer that for you. But as an investor myself, I would say, the deal works when it works for everyone. And so I've seen that time and time and again. And I've attended many classes. Actually, that's how Lindsey and I met. And so, just keeping that in mind that, the deal works when it works for everybody. And so if you're the IRA lender, talk to your borrower about what you're looking for and, what the deal structure is that will work for also the seller, for example. Sometimes you have to look at, and Lindsey gave us a great example during the webinar where she talked about she was going to have basically negative cash flow on a property. So she talked to the seller and say, hey, I'd love to help you out, but this is what we have to do in order for the deal to work, because, Lindsey's in it to help people and help people with their real estate problems, but she also can't do it for free or at a negative cash flow either. So that's always something that I see investors being very mindful of. It has to work for everybody. And so that's super important.
Absolutely.
And with that, I want to wrap up the webinar here. I just want to remind everybody that the slides are attached in the handout box, so you can download them and review them if you would like. I also want to mention, because I did get asked a few times, this is recorded. It is being recorded. The recording will be available because you all have registered. You'll get an email with it in the next 24 hours. It usually comes out pretty quick. It will be emailed to you. Just check your spam folder if you don't see it by, say, tomorrow evening, because a lot of times those emails with links and stuff like that do go to spam, so that's important too. You'll also find it on our YouTube channel. It'll be posted around the same time the email goes out, so that's a great way to get it. We did have someone else ask again, Lindsey, can you say the name of that software again? I think it just doesn't, it's hard to hear on the audio, but I think it was Buildium.
Yes.
Okay, so guys, if you're looking for that software, it's Buildium, like Buildium. I hope that's helpful. And so with that, we are going to wrap up. Thank you so much for joining us today,
Thank
Lindsey.